In this video, I'm going to lead you through why I believe it's time to buy now, what strategies to use, and why if you don't take advantage, your future self will most likely be quite disappointed. Look, we don't know when this ends. When it does end, most likely the economy will be weak, unemployment will be rising, and the problems will be clear to everyone. In fact, it will be then that analysts will be telling us how things are going to get much, much worse. There's not a bell that goes off and says, now is the time to get more aggressive. But there are signs. Hey there, I'm Colin Exelby. I own the virtual financial advisory practice, Celestial Wealth Management. I'm a certified financial planner and provide financial planning to business owners and their families that just makes sense. Before I tell you about the strategies I'm starting to employ right now, I want to point out important disclosures, because as a registered investment advisor, I am required to do so. The information in this video is for educational purposes. This is not specific financial planning, health insurance, or investment advice. In addition, everyone's tax situation is different. You should discuss your tax situation with a qualified tax advisor before implementing any planning strategy. In addition, these are my opinions about what is happening, strategies I personally am employing, and there is always the chance that they don't work out because we don't know what the future holds. Your tolerance for volatility and risk, while also taking into account your financial circumstances and your time horizon, should be important when designing your investment strategy. Now, as I film this, the stock market in the US, as measured by the S&P 500, fell 9% in September and is hovering near its lows for the year. That makes this one of the worst Septembers on record and the worst since 2002, when it fell by 11%. I remember 2002. That was rough, and a year later, the NASDAQ had fallen over 80% from its highs. Entire industries went into bankruptcy. Yes, that's the same index whose current top holdings are Microsoft, Alphabet, Amazon, and Tesla. The real estate market is slowing to a crawl, and the stories of significant price declines from coast to coast are all over the news. The bond market's declining as demand for old, lower-yielding bonds leads to price declines in most bond investments so far this year. The Barclays Aggregate Bond Index is down 14.72% year to date. Precious metals prices have held up better than many investments, but are down as well. Bitcoin, Ethereum, and other cryptocurrencies, they're now down over 50% from their highs. The best thing to do with money may be to put it under your mattress, or at least in short-term treasury bills, which are yielding just about 3.3%. Julian Emanuel, who is in charge of portfolio strategy at Evercore ISI, says, literally, the only bull market in the world right now is the bull market for cash. But I believe that for many investors, this advice is the opposite of what you should be doing right now. Look, the time to be defensive, if you are going to do so, is not when the financial markets have already dropped significantly, even though that probably would feel good as a rest from the pain of market losses. The time to be more defensive was back in 2021 or earlier this year when the cracks began to show. Not now. But are you a market timer? Can you accurately predict when markets will crash, exit them, and buy back in when they begin to rebound? There aren't many people walking this planet who can accurately predict and execute those exact strategies. So let's work through some more realistic strategies to employ. First, if you have a major goal in the next year, like a home purchase, college tuition bill, emergency funds, or annual retirement income, I firmly believe those funds should never be invested into an asset that could lose significant money like stocks or crypto. Those funds should be set aside in very low-risk accounts like high-yield savings, CDs, or the treasury bills that Mr. Emanuel mentioned. Cash is not trash. It never has been, even when it was yielding zero. Have you ever heard the saying, cash is king? That's because cash gives you options. It allows you breathing room because you don't need to sell any of your assets while they are down. It allows your portfolio time to recover before needing the funds. I will often advise clients, especially retirees, to set aside a portion of their funds in low-risk investments when a particular goal is close. Yes, you may sacrifice returns if the markets are doing well, but with that short of a time horizon, the return of your money is more important than the return on your money. Things could get worse from here, and they probably will. So if you have an upcoming goal, it's my opinion that those funds should not be invested in assets that could lose money. Let's assume now that your upcoming short-term needs are taken care of. What should you be doing? In my opinion, the first thing to do is to stick to your investment strategy. Don't have one? Well, now is the time to get your strategy in line with your appetite for risk and stick with it. Many investment advisors will have discussions with their clients about the level of losses they can withstand before they hit the eject button and abandon their strategy. And this is a good start. In my opinion, once this is determined, create a strategy that historically hasn't tested that level. That's right, choose a strategy that is at least one level less aggressive than what would cause you stress or lost sleep or the chance that you abandon it at the worst possible time. Alright, assuming you have that in order, if you are systematically adding to your portfolio with savings through a 401k, 529 plan, health savings account, or general investment account, keep doing it. Keep dollar cost averaging. This is when future returns are made. Having the discipline to continue investing at least the same amounts into a bear market has historically been the best time to add money. In fact, investors with the longest time horizons should hope for more bear markets like this so you can buy more shares at lower prices. During a market decline, most people see their investments going down in price, but don't really understand the opportunities their future self will appreciate. It's only after the opportunities came and went that we really understand. The dot-com bust and bear market back in 2000 to 2002 and the 2008 financial crisis gave investors two once-in-a-lifetime opportunities to buy shares at lower prices in less than a decade. It's tough, but resist the urge to invest less. Alright, assuming you continue to invest systematically, the next strategy is to move up a risk level. If you were a 60-40 investor, maybe now you become a 70-30 investor. It's a concept Research Affiliates founder Rob Arnott made famous. It's called over-rebalancing. I know it's crazy, but the financial markets are actually less risky today than a year ago when they were hitting all-time highs. You typically only receive above average returns when you invest additional funds or take on more risk after markets have declined. I would figure out what risk level you're comfortable taking and increase the risk in your portfolio to potentially capture the future returns of the markets. In my opinion, the second worst thing you can do is invest less money into stocks after they've fallen. By the time you realize the possibilities, it's already too late. What's the worst thing you can do? In my opinion, the worst thing you can do is abandon ship and sell assets just because their prices have declined in the short term. The price of future long-term returns is short-term market volatility. Remember that when investing. If you change your allocation because the markets fall, make sure you buy more stocks, not less. That's exactly what I am doing. My risk level was lower heading into 2022 than it normally would be for someone my age. But I'm now increasing the risk in my own portfolio to potentially take advantage of this downturn. I'm doing it in the most tax-efficient and low-cost ways possible to set my family up for future success. As the market moves higher over the next few decades, the money that works the hardest will be all those extra shares that you bought while the market was on sale. Next up, if you were considering a Roth conversion, now could not be a better time to run the numbers. That's what I'm doing. We are now in the last 3 months of the year. You should have a decent idea of what your 2022 income will look like. The financial markets are significantly down. Wouldn't it be nice to move some of those pre-tax IRA assets to a Roth IRA and never be taxed again? All that future growth without taxes for you and your family. potentially lower taxable income in the future. To learn more, check out the pros and cons of Roth conversions in this video. Now, in my introduction, I pointed out that these boom-bust cycles typically last 7 to 10 years. Go back and look throughout history. Boom-bust recovery, boom-bust recovery. It's actually pretty healthy. These cycles are often exacerbated by the Federal Reserve Bank of the United States. The Fed has the ability to increase and decrease interest rates, as well as increase or decrease the monetary supply. The Fed is currently hiking further and faster than at any time in modern history. It literally is different this time. And if you look back at history through this chart, you will see that from the bear market in 1966 all the way through to today, there has been a significant disturbance every 7 years. The 1973 recession, the 1980 recession, the 1987 stock market crash, the 1994 Mexican peso crisis, the 2001 recession, the 2008 financial crisis, the 2015 Chinese stock crash and US market decline, and the 2022 bear market and potential recession. The chart was created in 2015 by Nationwide Insurance, so it didn't yet have the 2015 and 2022 events. But Colin, why is this important? In general, people in the US begin to retire in their mid-60s. In the 5 years before retirement and in the 5 years post-retirement, often called the retirement red zone, you don't want to have a large portfolio decline, so your risk levels should be reduced. But if you are in your mid to late 50s, this may be the last best opportunity to increase risk and take advantage of this decline to build up your retirement funds. You have the time to wait for a market recovery because your retirement is still 7 years away. If you underfunded your retirement for one reason or another, I would strongly suggest saving a little bit more and investing a little more because there may not be more opportunities before you retire. I would be systematically increasing the risk in my portfolio over the coming 6 to 9 months so that if things get worse, I can potentially take advantage of the downturn. I would never make full-scale changes all at once, always move at a measured pace and never rush. Okay, that is all nice. Colin, but what if I'm retired? What should I be doing now? In general, my opinion is that once you've retired, you want to avoid the tax on stupid. Like in Keith Cunningham's book, The Road Less Stupid, the key to a successful retirement is to avoid the catastrophic mistakes. No need to catch the falling knife. The time to take high levels of risk has passed. At this point, the funds you need for retirement income over the next year should most likely be in lower risk assets. So you shouldn't need to sell your growth investments while they are down. I would use market rallies, and you get many of them in a bear market to create cash that you may need. But stick to your long-term strategy. If it was well thought out before this bear market, you shouldn't need to make any short-term emotional decisions. And if you're looking for other ways to supercharge your financial life, you will want to watch these videos next. In fact, you can also download my free ebook. The link is in the comment section.